breaking news coming in. The RBI has hiked the repo rate by 0.4%. The rate has been hiked amid a rise in inflation. For the Aam Aadmi, your EMIs are likely to go up. The cash reserve ratio has also been hiked by 0.5%. The RBI has hiked the repo rate by 0.4%. And that is the breaking news that we are getting to you right now. And my colleague Hina is joining us live on the broadcast for more on this. Hina, a surprise move by the RBI. The repo rate has been hiked by 0.4%.
Well, that's right. By 40 basis points in a surprise move, the Reserve Bank of India has increased the repo rate or the key interest rate. In simple terms, this is going to translate into higher EMIs for each one of us. Remember, just yesterday we had got this news for our viewers that HDFC has decided to increase the retail lending rate by 5 basis points. Your EMIs will get expensive. And now, with what the RBI, the Reserve Bank of India, has done today, your EMIs will get even more expensive. So be ready to pay more every month if you have any kind of a loan with you, be it the home loan, personal loan, vehicle loan, etc. Now, this is the implication of the action that the Reserve Bank of India has taken today. Now, what suddenly happened is the big question, and why suddenly the Reserve Bank of India has decided to do this? Well, there are a couple of things here. One, the inflation level has been rising continuously over the last few months. Last time, the wholesale inflation data that we got for last month, it was at 14.55%. Even the retail inflation was quite high and way above the comfort level of Reserve Bank of India. And during the last monetary policy review, the expectation was that the Reserve Bank will tinker with the rates because it was the right time to increase repo rate. But the RBI refrained from doing it. And now, in an off-cycle meeting that happened on 2nd of May, this decision was unanimously taken by the RBI that this is the right time to increase repo rate by at least 40 basis points. It's a big increase that has come today. Now, why has it been done is another important question. As inflation is rising, it's in any case eating into our savings. It's impacting each one of us very badly. And this is because of what's happening in Russia and Ukraine specifically. We do not know for how long the situation, the conflict between Russia and Ukraine will continue, and hence the time is right, according to RBI, to safeguard the interest of the people here in India, because inflation is hurting us. It is impacting the way we spend. It is impacting our purchasing power because everything is getting expensive. So the Reserve Bank of India feels this is the right time. Now, the timing of this move is also significant because tonight we are also going to get, the decision of US Fed on the rates there. So ahead of a decision by US Fed, Indian Central Bank has decided to increase repo rate. Joining us on the broadcast right now is Dr. Brinda Jagirdar, a banker, a very well known face in the entire banking industry. Dr. Jagirdar, thank you very much for joining us here on Mirror Now today. You were with me on the show, just day before yesterday, and we were discussing about the rate hike. And how will you react to this sudden surprise rate hike that we've got from Reserve Bank of India today?
Yeah, it has been a little surprising, but the timing has been surprising. But the governor has been preparing the market for this eventuality, so to say. Remember, RBI's action is always data-driven. They had very clearly said it's going to be driven by data. So what is the data telling us? One is inflation. Inflation rising up to more than 6.95% for March, and for April, it's likely to be more than 7%. So inflation is clearly a worry. And remember, the MPC target is 4 to 6%. So it's reaching the 6% target consistently for the last 4 months. So that is one worry. And the second thing, RBI had also said, we are assuming that the oil prices will remain at $100 per barrel. And that has crossed again, and it just continues to rise. So second, and the third thing is that the market rates have already gone up. Now, RBI had, when it starts tightening liquidity, what happens is the near-term rates go up much faster. So the near-term rates went up to 3.99%, 4%. And the long-term rates, as the 10-year yield has gone up to 7.2% now today. So given all this, it's very, very obvious that RBI couldn't sit back and do nothing about it. So inflation being the biggest concern, food prices, fertilizer prices, supply chain disruptions, and of course, the global central banks, they have also started unwinding and raising rates. So, so when all this happens, then RBI cannot sit back because they are connected, as the governor said, they're not an island. So I think this is the reason that why the RBI had to do what it has done. What has done, it has increased the repo rate and it has also increased the CRR. But interestingly, RBI said its stance remains accommodative while focusing the withdrawal on a multi-year time frame. So I think these are two important factors we have to look at because global growth is getting affected, global inflation is getting affected, which is reflected in what's happening in India also.
Hi, Vrinda. This is Avni Raja this side. Just wanted you to elaborate a little bit on, what you spoke about the RBI maintaining an accommodative stance despite the rates being hiked at this point in time. Cycle policy meet that happened here. What is the sense you're getting now going ahead as to how long this is going to take to actually show that effect of curbing inflation?
Inflation, RBI is doing what it can. But see, what the governor said, that it's the pandemic-related extraordinary measures. So those are going to, a withdrawal of those measures is being looked at, not just across the board cut in liquidity. So those extraordinary measures are being gradually, like for example, the government, RBI has already started shrinking its balance sheet right from August 21. And the RBI also discontinued the GSAP auction. So some part of liquidity they're trying to drain out slowly, but overall the liquidity support that is maintained to support growth, that continues. So therefore, and also RBI has said that it will withdraw the liquidity over a multi-year time frame. So it's not in a hurry to do that because that will be very disruptive of production. So RBI will continue to support growth. So we are standing behind whatever banks need, whatever the corporates need for growth, we will give. Because they have said that, see, imports, non-oil, non-gold imports have increased, capital goods imports have increased. That shows that it's supportive of growth. Manufacturing sector is also growing, capacity utilization growing, corporate balance sheets are looking good. So at this time, they don't want to drain out liquidity from the system.
Right.
So they say we will support growth.
Yes.
But the extraordinary measures we are withdrawing, that's all.
Yes, absolutely, Vrinda. So like you pointed out, several, aspects to this entire rate hike that we are seeing. Is it also an indication, the off-cycle rate hike at this point in time that inflation for the month of April could perhaps be more than what was earlier anticipated and higher than what was earlier anticipated?
That is the biggest fear, Avni. In fact, there are some estimates that the inflation for April could even be upwards of 7.5%. So in such a scenario, if this happens, then obviously people will say RBI is caught napping. So I think that is one big reason why the timing is what it is.
Yes, absolutely. Vrinda, thank you so much for joining us with your perspective.